For over a century, the relationship between the United States and Canada was defined by a simple, powerful idea: partnership. It was the world's longest undefended border, a symbol of shared values and deeply intertwined economies. Trillions of dollars in goods and services flowed seamlessly across this border, building a unique North American prosperity. But in the spring of 2025, that foundation was shaken to its core. On May 30th, 2025, President Donald Trump, in a move that stunned allies and economists alike, escalated the trade battlefield. Invoking the rarely used Section 232 of the Trade Expansion Act, he doubled U.S. tariffs on imported steel and aluminum from an already contentious 25% to a staggering 50%, effective June 4th. Washington framed it as a necessary measure to protect American industry and national security. But for its northern neighbor, the justification rang hollow. The announcement sent immediate shockwaves across North America, hitting Canada, America's top supplier of both metals and its closest geopolitical ally, with the force of an economic earthquake. In Ottawa, the response was swift and resolute. Prime Minister Mark Carney, a former central banker now navigating a geopolitical storm, wasted no time. Behind closed doors, his government launched a multi-pronged counterpunch, a strategy that would go far beyond simple tit-for-tat retaliation. It was a plan designed not just to absorb the blow, but to fundamentally alter Canada's economic destiny. Canada is signaling it will not be cornered. It is making a high-stakes gamble, betting that it can forge a new path, even if that means permanently rewriting the future of North American trade. America's tariff shock. The Trump administration's tariff hike was sold to the American public as a powerful tool to revive U.S. steel and aluminum plants, protecting them from what it called unfair foreign competition and securing a vital domestic supply chain. The promise was simple: bring jobs back and put America first. But the policy's first and most direct target wasn't a distant rival, but a next-door neighbor, Canada, producing over 15 billion CAD in high-quality steel annually, and supporting over 100,000 direct and indirect jobs, was squarely in the crosshairs. This wasn't just any steel, it was specialized steel for American auto parts, construction beams, and military hardware, deeply woven into the fabric of U.S. manufacturing. The situation was even more critical for aluminum. With an incredible 94% of Canadian aluminum exported to the U.S., the blow was immediate and existential. In towns across Quebec and British Columbia, where smelters are the lifeblood of the local economy, the news was met with disbelief and fear. Industry groups immediately warned of catastrophic consequences: factory shutdowns, mass layoffs, and a sudden spike in prices for consumers. The very integration that had been a strength was now a critical vulnerability, and the pain wasn't confined to Canada. Back in the U.S., the architects of the policy celebrated, but manufacturers braced for impact. Economists pointed out a fundamental flaw in the strategy. You can't punish your primary supplier without punishing yourself. The cost of steel and aluminum, essential inputs for countless industries, was set to skyrocket. Car makers in Detroit, aerospace firms in Seattle, and construction companies nationwide faced a sudden surge in costs, threatening their competitiveness and forcing them to pass the price hike onto American consumers. Canada's countermove. Ottawa's response was not just forceful, it was surgically precise. The government unveiled 25% retaliatory tariffs on nearly 30 billion CAD of American goods. The list was strategically crafted not just for economic impact, but for maximum political pain. It targeted iconic American products from key political districts: bourbon from Kentucky, dairy from Wisconsin, oranges from Florida. The message was clear: if the U.S. was going to inflict economic pain, Canada would ensure that pain was felt directly by the voters who supported the policy. But Prime Minister Carney's plan went much further than a simple trade skirmish. The tariffs were the shield. The sword was a massive, long-term investment in national infrastructure. Canada announced it was accelerating major projects designed to break its economic reliance on the United States. This included expanding nuclear power plants to ensure energy independence and, most critically, building out new Asia-focused trade corridors. The goal wasn't just short-term payback. It was a fundamental strategic pivot, a policy shift that had been debated in Canadian circles for decades but never fully acted upon. The U.S. tariffs provided the political will and the public urgency to finally execute it. The strategy is to aggressively diversify markets, reducing the country's historic and now painful dependence on U.S. demand. Canada was determined to prove it could thrive without being a captive market for its southern neighbor. A new economic direction set in motion. The oil card. If steel and aluminum are the opening salvo in this trade war, oil is Canada's real leverage, its economic nuclear option. Every single day, Canada ships 3.8 million barrels of crude oil to the United States, a staggering volume worth over $130 billion annually. This makes Canada by far the largest and most reliable foreign oil supplier to the US, but the dependency runs deeper than just volume. For many massive American refineries, especially those in the Midwest and Gulf Coast, Canadian heavy crude is technically irreplaceable. These multi-billion-dollar facilities were specifically designed and calibrated over decades to process the unique heavy sour crude that comes from the Alberta oil sands. Switching to lighter crude from other sources isn't like changing brands of coffee. It would require a prohibitively expensive and time-consuming retooling process, costing billions and potentially idling the plants for months. This gives Canada immense, albeit risky, leverage. Financial analysts estimate that even a partial redirection of this crude to hungry Asian markets could cost the U.S. economy $30 to $35 billion a year in higher energy costs and lost refinery output. At the same time, it would dramatically boost Canada's influence in trade relationships with emerging superpowers like China and India. For now, Ottawa isn't threatening outright bans or export taxes on oil. The move would be too damaging for both sides. But by accelerating its Asia-focused infrastructure, it is making it crystal clear to Washington that its energy security is not guaranteed, and that oil is Canada's ultimate bargaining chip, the Trans Mountain expansion. No project better embodies Canada's strategic pivot away from U.S. dependence than the Trans Mountain Pipeline Expansion, or TMX. For years, the project was mired in controversy, facing fierce environmental opposition and political hurdles. In a bold move, the Canadian government itself bought the pipeline to ensure its completion, a decision that was heavily criticized at the time. Now, in the face of U.S. trade aggression, that gamble looks prescient. With its recent completion, TMX has nearly tripled the flow of oil from Alberta to Canada's Pacific coast, boosting capacity from 300,000 to 890,000 barrels per day. This single piece of infrastructure effectively breaks the American monopoly on Canadian oil exports, and it immediately unlocks lucrative Asian markets, where oil often sells at a premium compared to the discounted prices Canadian producers were forced to accept from U.S. buyers. The results are already clear. In March 2025, just before the tariff announcement, China imported a record-breaking 7 million barrels of Canadian crude through these Pacific ports, instantly making it a top-tier buyer. Other nations like India and South Korea are quickly signing new supply contracts. For the government in Ottawa, this project is no longer just about energy economics. In this new era of confrontation, TMX has become a vital geopolitical lifeline, a steel artery ensuring Canada cannot be economically strangled or held hostage by American trade policy. A lifeline in motion, charting a new course on the global energy map, counting the costs. As the trade war intensifies, both sides face mounting economic turbulence. The integrated nature of the North American economy, once its greatest strength, is now the source of shared pain. Canadian manufacturers of steel and aluminum risk losing access to their largest and most important market, threatening thousands of jobs. Meanwhile, American industries that depend on those very materials, from automakers to appliance manufacturers, face soaring costs that erode their profits and global competitiveness. Nowhere is this shared vulnerability more apparent than in the auto sector. For decades, the big three automakers have operated as if the border didn't exist. A single component might cross between Ontario and Michigan half a dozen times before being installed in a finished vehicle. Now, with tariffs applied at multiple stages, the cost accumulates exponentially. Supply chains, once models of efficiency, are now exposed as fragile and dangerously exposed. The human cost is mounting. In border cities like Windsor, Ontario, and Detroit, Michigan, communities whose fortunes have been linked for a century now face a shared anxiety. One policy shock in Washington, or one pipeline redirection in Ottawa, can have devastating consequences, disrupting factories, shuttering businesses, and threatening the livelihoods of families on both sides of the line. The effects are becoming visible to everyone, from the price of gasoline at the pump in Illinois to the price of a new truck in Texas. And while some protected sectors, like Canadian dairy, may see short-term benefits, economists warn the overall impact is overwhelmingly negative, creating a lose-lose scenario for the continent as a whole. What began as a single tariff increase has spiraled into a full-scale test of North America's economic resilience, forcing a painful re-evaluation of a century-old partnership. Canada's aggressive counter-strategy, combining retaliatory tariffs, a massive infrastructure push, and the strategic deployment of its energy resources, shows it is preparing for a future permanently less tied to Washington. Meanwhile, the United States, in its bid to protect domestic industries, risks creating higher costs, persistent inflation, and crippling supply chain instability at home. This is more than a temporary trade spat. It is a seismic event that is forcing a realignment of global commerce. Other nations are watching closely. The European Union is accelerating trade talks with Ottawa, seeing an opportunity to displace U.S. suppliers. Mexico is caught in an awkward position, trying to maintain its own trade relationship with the U.S., while navigating the fallout between its two North American partners. The conflict is fundamentally about who will control the flow of critical metals, essential energy, and high-value markets in the turbulent decades ahead. The long-standing special relationship, built on trust and mutual benefit, has been fractured. The question is no longer simply whether these tariffs will protect American industry or accelerate Canada's pivot to Asia. The question is whether the era of a unified North American economy is over, and what this new, more fractured and competitive landscape means for the future of global trade and the balance of power itself.